This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Mouse meet Fox. Disney and 21st Century Fox discuss a deal to move some Fox assets into the Mouse House. Media stocks swirl on the reports. What such a deal would mean for moviegoers, television viewers, and investors.
Day of deals. Broadcom goes after Qualcomm for more than $100 billion. But might Apple complicate things?
And new danger? Alone in a house with a stranger. That's the daily routine of real estate agents who are now turning to a new app to help keep them safe. Those stories and more tonight on Nightly Business Report for Monday, November 6th.
Good evening, everyone, and welcome. A landmark deal in the tech industry. We told you Friday it was likely to happen, and today it did. We'll get to that story in just a moment. But we begin tonight with deal buzz in another sector, the media sector. As first reported by CNBC, 21st Century Fox has recently been in talks to sell most of its assets to Disney. Even though the talks have ended, it shook the sector and sent a number of stocks in this beaten-down group higher. 21st Century Fox rose nearly 10%. Disney was up 2%. Viacom, Discovery, and CBS also rose. David Faber broke the story.
21st Century Fox has been holding talks to sell most of the company to Walt Disney, leaving behind a media company tightly focused on news and sports, according to people familiar with the situation. Now, the talks have taken place over the last few weeks, and given their complexity, it continues to be seen as a tough deal to get done by those who've been working on it. The two sides are not currently talking at this very moment, but given the on-again, off-again nature of the talks, they could be revisited, particularly given the market's favorable response to the deal since we broke news of the talks. For Fox, the willingness to engage in sale talks with Disney stems from a growing belief amongst its senior management that scale in media is of immediate importance and that there is not a path to gain that scale in entertainment through acquisition. The company is said to believe that a more tightly focused group of properties around news and sports could compete more effectively in the current marketplace. It also is evidence of its dwindling hopes for buying the 61% of BSkyB that it does not already own. Now, that deal already enduring significant scrutiny from UK regulators. The media landscape has changed considerably in recent years. Giants such as Facebook, Google, Amazon, and Netflix are changing the way people consume media and dominating the digital distribution of digital video content. Being able to compete in that changing landscape, many people believe, requires scale. Now, that is scale that Disney does have, but 21st Century Fox may not. For Disney, the opportunity to take control of another movie studio and significant TV production assets as it readies a direct-to-consumer entertainment streaming offering is attractive, as is Fox's significant exposure to international markets such as the UK, Germany, and Italy, both through its networks and its 39% ownership of BSkyB. Disney recently announced it will pull all of its movies from Netflix and will establish two direct-to-consumer offerings, one for sports and one including its key franchises such as Star Wars and Marvel. Disney also would not purchase all of Fox. People with knowledge of the talks tell me the company would not buy the Fox broadcast network. It wouldn't buy Fox's sports programming assets, given the antitrust implications of that deal. It wouldn't buy the Fox News or Business Channel. Disney also not interested in buying Fox's local broadcasting affiliates. So in fact, the assets left behind contribute what seems to be a larger portion of the overall company's cash flow than those that would be sold. In addition to the movie studio, though, TV production, international assets, Star, Sky, Disney also adding entertainment networks such as FX and Nat Geo. Now, the contemplated structure of the deal or the price that has been discussed could not be obtained. Officials at Disney and Fox declined to comment. For Nightly Business Report, I'm David Faber at the New York Stock Exchange.
Robert Luna joins us now to discuss what a potential Disney and 21st Century Fox deal could mean for the ever-changing media landscape. Robert, welcome. Good to have you with us. Obviously, these talks are in a very embryonic stage. They may not even be going on right now, according to Faber. It's pretty clear that those talks, such as they did exist, were defensive on the part of Fox. Are they offensive on the part of Disney or defensive for them as they try and protect against Netflix and Amazon?
Well, it's interesting that you say that, Tyler, because I think this is right now a shot right from Bob Iger, the CEO of Disney, at Reed Hastings, the Netflix CEO, So as was mentioned prior, all their content was just pulled out of Netflix. And with the direct-to-consumer offering, I think it's a realization, so somewhat offensive and defensive, by Bob Iger and Disney, that they're going to need to create a more robust offering for that to be able to succeed on its own merit. So I think grabbing things like Avatar and X-Men from Fox is something that they're going to need to do to be able to compete.
From an investor's standpoint, if the deal is structured as David Faber reported it right now, with the details that we know, is this a good deal for the stock prices of those companies and therefore investors?
I believe so, right? Because you have to be a good operator in this new media network here, and that's really what Disney is, and their ability to acquire properties like they have with Lucas, like they have with Pixar, and immediately monetize those is proven. So I think if you look at Disney stock up today, obviously if you look at Fox up 10%, because I think the realization from investors there is they don't have the scale. And again, Sue, it all comes back to content. So when you even look, this is transcended over into the telecom space. When you look at two telecom companies today, AT&T and Verizon, while they were both down, Verizon was the one that really got hit because AT&T with DirecTV and the talks with Time Warner has more of the content that we're talking about, where now if Disney's pulling Fox off the market, that leaves Verizon in a very vulnerable space. So they were down over 4% in today's tape.
And the bleed through into other media stocks, as Sue noted a moment ago, was pretty significant. Viacom, CBS, and others moving up. Discovery on the idea that there will be more deals to put scale together.
Well, there really has to be, and we saw last year the deal between Viacom and CBS fell apart, and I think that left companies like, especially Viacom, in a very vulnerable position. So I think investors are bidding some of these companies up on the fact, like you said, Tyler, that there will be further consolidation. Mm-hmm. You know, that's a double-edged sword, though. There's going to be winners and losers in that. Right. So broadly buying these companies could be, a tough way for investors to go.
All right, Robert, thank you so much. Robert Luna with SureVest Wealth Management.
Thank you.
And now to that landmark tech deal. Broadcom wants to buy Qualcomm for about $105 billion. If completed, it would be the largest technology takeover ever, creating the third largest chip maker right behind Intel and Samsung. The sheer size of this deal has the potential to change the electronics industry. There are reports that Qualcomm will reject the unsolicited offer, but has so far only said that it's assessing the proposal. Shares of both companies rose today, extending Friday's run-up, but the tie-up could get complicated for another reason, and that is Apple. Josh Lipton explains.
Qualcomm has a few very important customers, including suppliers to Apple that generate a significant amount of revenue for the company. But Qualcomm and Apple are now locked in a nasty legal fight. The dispute is about how much Apple should have to pay Qualcomm for its patented technology, which allows phones to connect to wireless networks. Qualcomm wants a percentage of the iPhone's selling price. Apple wants to pay something closer to a flat fee. So what would a Broadcom deal mean for Qualcomm's fight with Apple? A combined company would be a technology powerhouse, and that means it could have that much more pricing power, perhaps squeezing customers like Apple for more money. But some say the more likely outcome would be Broadcom CEO Hock Tan striking a new deal with Apple. Tan, who was just at the White House, could capitalize on his relationship with the iPhone maker. After all, Broadcom already supplies critical components to the iPhone franchise, including the technology that enables wireless charging. If Broadcom really does end up buying Qualcomm, perhaps Tan could convince Apple CEO Tim Cook to put an end to this fight by cutting a new long-term contract with him. Tan is, of course, well aware of how important Apple is to Qualcomm. It's estimated that if Apple is lost as a customer, it could hurt its bottom line. Certainly, Cook doesn't seem to have much love left for Qualcomm at this point. When asked recently about whether Apple needs Qualcomm to keep making and selling those premium devices, Cook simply responded, no. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Intel and AMD are usually rivals, but today they are teaming up to battle NVIDIA. A new laptop computer chip will combine Intel's processor and AMD's graphics unit. That will help laptops run intensive video games, a factor that sells those devices in a very competitive market. Now, NVIDIA, known for its work in the artificial intelligence industry, is also considered the standard bearer in gaming semiconductors. Shares of AMD up 7%. Dow component Intel and NVIDIA were also higher.
So let's turn now to Dan Ives to talk more about the recent activity in the chip sector and if he sees it continuing. He's the Chief Strategy Officer and Head of Technology Research at GBH Insights. Nice to see you, Dan. Welcome.
Great to be here.
So what do you think is behind all this activity, and especially this latest deal with Broadcom? It's a huge deal, obviously, but what's driving these companies to merge or acquire each other?
Yeah, I mean, this is a game-changing move. I think Broadcom really sees Qualcomm in a position of weakness here with the Apple legal fight, as well as some fundamental headwinds. And I think really when you going forward, it's going to be a secular growth market. It's about them getting bigger. They view this as a window of opportunity for them to really put a leg up against guys like Intel and AMD. So this is a strictly offensive move, and Broadcom's in a position of strength here. Qualcomm's in a position of weakness.
Qualcomm at $70 a share. Do you think that's a price that gets it done?
No, I mean, I view in terms of a bull sort of scenario that would sort of get this done in the $75 to $80 range. So I view this as a game of high-stakes poker. It's just started. 75 to 80 is where I could see a deal getting done, even though there'd be significant regulatory approval to get forward.
Well, I was just going to ask you, is that the main roadblock here?
Well, I think there's two. I mean, regulatory is definitely going to be a big roadblock here. Potentially they have to divest some assets. But then it comes back to shareholders. I mean, you look at Qualcomm, the Apple situation's been a nightmare. You've seen the stock majorly underperforming under semi-stocks. So it really comes down to shareholders where fundamentally they think the value is. I think at 70 doesn't get done. I think if they come back at a higher price, that's where I think this becomes a serious deal that ultimately could get consummated and would ultimately change the landscape, not just the semis, but across tech. And I think Cupertino and Cook are watching this very closely as they play a major role in it.
I think they probably are. Thank you so much, Dan. Appreciate it.
Thanks.
Dan Ives with GBH Insights.
Well, today's deal-making talk lifted sentiment and sent all three major U.S. equity indexes to records. Energy shares also rose as oil prices rallied. Here are the closing numbers. The Dow Jones Industrial Average added 9 points to finish at 23,548. NASDAQ rose 22, S&P 500 up 3.
President Trump is in Asia, finishing up his visit to Japan with some tough talk on trade. His next stop is South Korea. Kayla Tausche is in Seoul tonight.
After a weekend of golf, fine dining, and diplomacy, President Trump got down to business.
We're making tremendous progress, I believe, on trade.
Addressing U.S. and Japanese companies, defending his decision to ditch the Trans-Pacific Partnership on his third day in office. Japan is now trying to salvage it.
We will have more trade than anybody ever thought of under TPP, that I can tell you. TPP was not the right idea. Probably some of you in this room disagree, but ultimately I'll be proven to be right. We will have much bigger trade with the way we're doing it right now, and it'll be a much less complex situation.
In the meantime, bilateral talks are slow going. Last month, an agreement for Idaho potatoes and Japanese persimmons, but Trump wants a bigger win.
Whereas virtually no cars go from the United States into Japan.
Auto companies are already taking a page from Trump's playbook, building factories and creating jobs in the United States. Denso, a $1 billion plant in Tennessee. Toyota and Mazda, a $1.6 billion plant and up to 4,000 jobs.
That's big stuff. Congratulations. Come on, let me shake your hand.
The trip represents a tour through the U.S.'s top trading partners overseas. Looming over the economic agenda, increasing tensions with North Korea, and a diplomatic strategy that may come up empty.
But the president recognizes that we're running out of time and will ask all nations to do more.
In South Korea, peaceful protests await the president, some welcoming his arrival and military protection, others blaming him for provoking war with Pyongyang. 3 days in, President Trump has dialed back his rhetoric toward North Korea, but ratcheted up his signature tough talk on trade. The White House says the breadth alone of this trip, the longest for a U.S. president in a quarter century, shows his commitment to the region. For Nightly Business Report, I'm Kayla Tausche, Seoul, South Korea.
Still ahead, one of the world's richest and most recognizable investors is caught up in a corruption crackdown. The president of the New York Fed, William Dudley, will retire next year before the end of his 10-year term. It was scheduled to expire in January 2019. Mr. Dudley also made news today by cautioning elected leaders not to go too far in dismantling financial regulations put in place after the financial crisis a decade ago. In a New York speech, he left room for some tweaking, but said that too much change could expose the economy to renewed risks. Mr. Dudley's position is a very important one. The president of the New York Fed always votes at policy meetings. The board of the New York Fed chooses the next president.
Well, you may have heard about something called the Paradise Papers. It is a trove of leaked documents made public yesterday by a group of about 100 media organizations. They show how some of the top politicians and celebrities get around paying taxes, often using offshore funds that are not illegal. The papers also reportedly show how state-run Russian companies funded large investments in Twitter and Facebook and have led to some questions surrounding Commerce Secretary Wilbur Ross. Eamon Javers has more.
Another astonishing data breach, this one reminiscent of last year's Panama Papers. This time, they're calling it the Paradise Papers. Here's what we know about this incident. About 7 million documents of a law firm called Appleby, which has offices in Bermuda, have been taken and given over to a German newspaper. They were then shared with an international consortium of investigative journalists, and they provide a rare insight into the global offshore financial world. More than 120 politicians and global royal rulers have been identified in this treasure trove of documents. One of the people coming under scrutiny here is Wilbur Ross, the Secretary of Commerce here in the United States. Ross shares business interests, NBC News reported, with Vladimir Putin's immediate family. Ross failed to clearly disclose those interests when he was being confirmed earlier this year. He retains his interest in a shipping company called Navigator Holdings, and it's Navigator Holdings that had a business relationship with a Russian energy firm that was controlled by Vladimir Putin's son-in-law. Nonetheless, on CNBC today, Wilbur Ross said he had done nothing wrong.
There's nothing wrong with it at all. I think it's just an example of the press trying to find anything they can, however remote or silly, to attack the president and somehow link him to Russia. This is nonsense.
There's no indication at this point as to who stole the documents in question. The law firm here says that it was the victim of an illegal computer hack. For Nightly Business Report, I'm Eamon Javers in Washington.
CVS Health beats expectations, and that's where we begin tonight's market focus. The drugstore chain's pharmacy business processed more claims in the quarter, and that helped overall results edge past analyst estimates. But same-store sales fell as the company struggled to get more shoppers into its locations. CVS didn't comment on reports it may buy the health insurer Aetna, but it did say it plans to offer next-day delivery for prescriptions and retail products starting next year. CVS shares were off 3% at $66.80. Valeant said it would sell Sprout Pharmaceuticals after former Sprout shareholders expressed dissatisfaction with how Valeant marketed its female libido drug. Valeant bought Sprout and its Ad-E medication just 2 years ago for $1 billion, but hasn't seen the drug put up any kind of impressive sales numbers. The price of the deal not disclosed. Valeant shares up nearly 5% at $12.04. And Mylan said weaker North American sales of its EpiPen caused overall revenue to come up short. The drug maker also missed profit estimates. and earlier than expected approval for Mylan's generic multiple sclerosis treatment prompted the company to raise the low end of its sales and profit forecast for the year. Mylan shares up more than 4% at $37.39.
Despite reporting a drop in profit due to higher expenses, the drug distributor Cardinal Health still managed to top estimates. Revenue was disappointing as low generic prices hurt results. Cardinal also said its CEO will step down next year and the company's chief financial officer will take his place. Shares fell nearly 2% to $60.25. Sprint and T-Mobile have called off merger talks, marking the second time in 3 years the companies have walked away from a potential deal with each other. The company said that they were unable to agree on terms. Sprint shares were off 11.5% to $5.90. T-Mobile shares were down 5% to $55.54. Michael Kors' decision to offer fewer discounts is paying off for the handbag maker. The company reported results that improved from a year ago and said it was raising its guidance for fiscal 2018. Shares of Michael Kors popped 14% to $54.62. After the Bell Red Robin Gourmet swung to a profit, but it missed street expectations. Sales grew at the restaurant chain, but those results also disappointed. The shares plunged in after-hours trading, but ended the regular day up just a fraction to $67.05.
Well, as we mentioned, oil prices rose today and got a lift in part because of a corruption crackdown in Saudi Arabia. Caught up in the crackdown was Saudi Prince Al-Walid bin Talal, an influential businessman with stakes in companies like Twitter, Citigroup, and Lyft. Hadley Gamble is in Riyadh.
It was a major purge of the rich and the powerful here in Saudi Arabia over the weekend, a sweeping crackdown on big business, current and former government ministers, and even members of the royal family. Possible charges include corruption, money laundering, and abuse of power. One of the most prominent names on the list, billionaire investor Al-Walid bin Talal. As a member of the Saudi royal family, he's also chairman of Kingdom Holdings, with some high-profile investments in the likes of Twitter, Citigroup, and the Four Seasons Hotel. As Kingdom Holdings shares traded down for a second day, the company released a statement with the CEO claiming the company had the full support of the Saudi government. The ongoing investigation seemed to be gaining traction on Monday as local news reports cited Saudi authorities as already freezing some of the assets of those involved. And while many Saudi analysts say this is a major power play by the Crown Prince to solidify his base, the Crown Prince himself says this is about tackling corruption from the top down, something he has to do if the country's going to have a real shot at attracting foreign investment. And the message is clear: no one is above the law. For Nightly Business Report in Riyadh, I'm Hadley Gamble.
Coming up, an app that more realtors are using not to sell homes, but to stay safe.
You may soon find more discounted items on Amazon. Ahead of the holiday season, the company will cut the price of some products from third-party sellers and will cover the cost. Amazon historically only discounted items it sells directly. This is one reason why some suppliers chose not to sell on Amazon, so that they can control their own pricing strategies.
A new technology is raising the alarm about a crime affecting both real estate agents and people hoping to sell their homes. It is offering what could be a life-saving solution. Diana Olick has that story.
Being a real estate agent has never been the safest job. After all, you're meeting strangers in empty houses. But now the risk is even higher due to the nation's opioid crisis.
When you're talking about potentially opening up access to a home, right, to an environment where prescription drugs may lie, right, in a medicine cabinet of a house that's listed for sale, with doing no vetting or checking on an individual and giving them access to that house, I think we're feeding into a crisis by creating these channels of easy access to drugs.
Riley is CEO of Forewarn, a new company offering real estate firms and licensed agents deep background checks on clients using high-level government-regulated data from its parent company, Cogent. Not just criminal history, but financial and other personal information, all on desktop or mobile app. It's the kind of thing San Antonio realtor Janice Tisdale wishes she had had back in 2010. She was hit over the head by an admitted drug addict who had booked a tour with her at a $750,000 home. He then held her hostage, demanding money.
I had Googled him that day, or not that day, but the week prior, and I couldn't find anything out about him. And so it just made me feel very uncomfortable about him.
Tisdale convinced her assailant to go to his car to get paper. She said she would sign a note saying he didn't hurt her. When he did, Tisdale ran. Thankfully, she found a group of kids nearby who led her to a police officer.
He held me hostage on the porch for 45 minutes, and it was a very scary situation.
Forewarn CEO says his technology is not just about raising a red flag, but perhaps a yellow flag. So if even the basic information a client gives the agent isn't true, the agent will know not to show up at the meeting alone.
This is proactive rather than reactive, right? So in terms of the yellow flags, as we call them, that an agent may see when running Forewarn on an individual, maybe first of all that the phone number doesn't match who the individual says they are.
Tisdale agrees the more information, the better.
I guess I always thought I was aware, but you never think it's going to happen to you. And it does. It can. And it did.
For Nightly Business Report, I'm Diana Olick in Washington.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
Thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you tomorrow night.